Good morning, good morning, good morning. This is the Morning Blast with myself, Ryan, and of course, Michael. It is Tuesday, the 17th of March, all day. This is we think maybe one of the most candid market-related podcasts out there going. We certainly don't give a shit if we swear or anything. And also, we like to think we call it like it is, which is increasingly not what people on social media are doing. But enough of that. Just a reminder, nothing we say on this podcast is trade or investment advice. We don't make any apologies for the lack of editing that goes into these things. This is, take us as you find us, etc., etc. Michael, how are you, my dear friend?
Yes, indeed. Very good morning to you, Ryan. Good morning, everyone. I'm not too bad at all, thank you, mate. And you sound a little bit more sprightly this morning than you did yesterday. Have you discovered a cure for your man flu?
Well, I wouldn't say a cure.
Or boy flu in your case?
Yes, boy flu. Steady. I am.
Get your mind out the gutter.
I have been having quite considerable amounts of Lemsip, so I'm either tripping balls on Lemsip or I've got man flu. I don't know which one it is, but you're right for noticing. I am feeling slightly better.
Well, either way, you're soldiering on like a trooper. So give yourself a little pat on the back.
I do. My mum does keep telling me that I'm a brave little soldier and all that. Yeah.
Do you get a little lollipop after you've taken your Lemsip to take the taste?
I said my mum, not your mum.
Oh, you can fuck off.
Right, moving.
Someone's feeling better, aren't they?
I am feeling a little bit. Or is it because I talk to you?
Right. Yeah, I just brighten everyone's spirits, mate. You ask anyone at Pemberstone, they'll say I'm the life and soul of the party, and a cheeriest man in the office.
When I see you walking into the bar, that's exactly what I feel. Everyone's like, it's like the cheers. Everyone goes, "Yeah, Michael."
Oh, I thought it was groans normally, but
oh yeah. Right, let's move swiftly on.
Because it is going off the rails already.
Yeah, even for us, this is a good one. Right, update from my dear friend Clive Lambert over at Futures Techs. Me and Michael are quite proud of this because Clive is starting to comment on fundamentals and market mechanics slightly more than technicals every now and again now. As Clive leads off correctly, as if there isn't enough confusion in the equation right now with what's going on macro-wise and fundamentals and technicals, etc. We are also mid-roll. So a lot of places have already rolled. Yesterday would have been the last day on the March contracts for those that trade in the quarterlies. S&P spring to mind, NASDAQ, etc. on the futures. And it's obviously witching week as well for equities. So the S&P saw...
Oh, sorry. I was just to say very quickly. I know I've brought this up before, but one thing that people do need to be quite careful of, particularly in terms of crude and not just Brent and WTI, but all the other various benchmarks out there as well, because there is a roll going on right now. If you are looking at things like spreads, make sure you're comparing like with like and comparing a May contract with a May contract and not, getting things, comparing apples with oranges, so to speak. So just be a little bit careful of that one.
No, exactly that. And you're right. We did mention that a couple of weeks ago when people were kind of losing their minds over Brent WTI spread. Or was it last week? I was all merging into one, to be honest. Anyway.
It really is.
S&P saw green yesterday, retaking its 200-day simple moving average in the process. Ditto for the Dow and NASDAQ. DAX is still shy of the Fibonacci resistance at 23,729, so pointed lower for now. FTSE futures once again failed at or around the 10,359 level. Again, bearish news technically. Bund futures put on some green on the chart, as did the T-notes, which has put some distance on the support at 111, spot 07.5 to 111, spot 11. In the dollar, weakness against most of its peers yesterday. So Eurodollar has put some distance on supports at one spot 13.91 and one spot 13.67. Bitcoin, that got up to 76,000 overnight, but it's back below the 74,500 level as Clive wrote this all down. So I don't know where it is right now. Gold and silver both posted doji candles yesterday, all wick, no body. Zinc saw weakness and is eyeing support. We haven't had zinc for a while. Eyeing support at 3,239 and 3,221. That's where the support is in zinc for now.
Of course, that's the reason why the LME put on a trading halt yesterday.
Absolutely. Yeah, no, absolutely.
That is a joke before anyone comes
to
for me.
To be fair, to be honest, I was kind of dozing in out of consciousness yesterday, so I didn't really see much. But I didn't see any conspiracy theories around the LME, which was a nice change.
Yeah, exactly. It was actually, yeah.
But we'll wait and see. Aluminium off the highs, more red yesterday. 3,424 is the Marabouza resistance in that one. Oil benchmarks, that's all red yesterday, but we've got a chunk of it back overnight. So still responding to headlines and news flow, obviously. Henry Hub, the US nat gas benchmark, failed recently at the Fibonacci resistance at 3 spot 27.5, tracking back to its 3 spot 00 level yesterday. The big figure. TTF had a quiet session and a muted start again yesterday. Quiet session yesterday, muted start today, should I say. So taking a blow for now. EU car, I don't know what taking a blow means. So taking a blow to me means getting sold off, but like a blow as in a punch. But that's Clive and his vernacular.
No idea.
Yeah, well, vernacular or vernacular, I don't know. One's a railway.
Vernacular's a railway.
Yeah, there you go. Close enough. Look, I did well to have a multiple syllable word at the moment.
As Clive said, just read it out.
EU carbon has started today with weakness through the recent low at 67.60. So no let up for the bulls there. 65.25 and 63.26 are the next downside targets. Wheat, the ginger stepchild of US agricultural markets, that failed at the Marabouza resistance at 613.6 and sold off to 594.5, which is short-term Fibonacci. Soybeans, that got massively hit yesterday, obviously on the China comments. Soybeans posted a big red candle, which broke supports of plenty. So that suddenly reversed. 11 at 14 and 4 is the next downside target. 11.62 and 11.84 resistance to watch on the recovery attempt. So just anyone that's wondering what happened there. Soybeans, obviously, big customer for US soybeans is China. Trump came out as expected and said, we have mentioned on the show previously that it's looking likely that the talks may be delayed. And if that's exactly what Trump had asked. But he's actually announced that he would like to, and he's asking Xi if he can delay him by a couple of months. Soybeans took this very negatively and really got bashed on the head and fell out of bed.
Yes, which does make sense. And thank you, of course, to Clive for that, as always. However, I do think it's important. And actually, I think soybeans and soybean oil, which is Tom Wiseman's favourite thing in the world, I think they spent most of yesterday just stuck at limit down. Yeah. The one thing that is just worth bearing in mind with that, and as you rightly say, Ryan, President Trump did say towards the back end of yesterday's session that he's going to ask President Xi to delay that summit for around a month. This isn't. And actually, I think this is not a case of Trump trying to get negotiating leverage or, Trump basically being annoyed with the Chinese. Is pretty much down to the fact that there's a war going on and it's probably not a great time to be flying halfway around the world to chat about trade with another world leader. So I don't think we need to read sort of too much into that. Clearly, it was a negative in certain parts of the ag market yesterday because the prospect of, further near-term purchase agreements has been diminished slightly. But I don't think it's a massive game changer on the whole.
I mean, I agree. Like, obviously, who knows what Trump's thinking and who knows how long this is driving on for. Personally, just at face value, it almost feels like the wrong market got slapped because, yes, this is, near-term downside, near-term kicking the balls for soybeans and US ag products that could be bought by China. But I think the underlying message that I'm taking for this is, he's not angry with China. He's not like they're not falling out, as far as I can make out. But what is important to understand is this: if he's looking to delay the talks for a couple of months, this really impacts the timeline that kind of people are kind of pricing in because Trump's saying it could be a few weeks, 4, maybe 5 weeks. But if he's trying to delay by a couple of months with China,
you're talking about the timeline for the Iran war.
Yes, right, the timeline in the Middle East. So potentially this could be going on for a lot longer than what people are thinking.
Yeah. And I think that is actually the right way to look at it because, and we can talk about the Middle East in a second, but if you look at the readout from those US-China talks that were taking place in Paris over the weekend and yesterday, it was all very positive. Scott Bessent, the Treasury Secretary, was saying that the meetings were very good, that they've explained how the IEEPA ruling translates into the new tariff regime that China will be subject to. And importantly, it wasn't just Bessent's readout that was positive. The Chinese side was as well. They were talking about a potential extension of the tariff extension, which is a rather clumsy way of saying basically we'll kick the can down the road a little bit more in terms of this pause that's still in place. They were again saying that they've agreed to maintain stability and continue to engage in discussions, etc., etc. So, yeah, I would absolutely say that actually reassuringly, I think we can put kind of trade worries to bed just a little bit for the time being. But you're absolutely right and correct to say that the implication is, and again, Trump said yesterday that, he thinks the war will end soon, but not this week. He did say that this time last week as well, but never mind.
90%.
Yeah, it is getting a bit like that. But of course, the public statements don't necessarily tally with the actions, because as you rightly say, if you're delaying a summit for a month or 6 weeks, you're probably not expecting this to be wrapped up in the very, very near term, at least.
Yeah, no, exactly that.
Anyway, we might as well move on to the Middle East. I mean, I would say that, broadly speaking, somewhat calmer tones did prevail yesterday in terms of the headline front and in terms of financial markets. What we saw actually was crude coming lower and equities rallying, as Clive alluded to, although it is worth bearing in mind that that's exactly what we saw last Monday, and then both of those moves reversed as the week wore on. I think it's also important to stress that nothing fundamentally has really changed. We are still dealing with intense kinetic action, the US and Israel continuing to strike various targets in Iran. Trump saying yesterday that the US has struck more than 7,000 targets now across the country. Iran is continuing to strike not only military targets, but also increasingly looking to target energy infrastructure in the region. We had news this morning that the port of Fujairah, which is in the UAE, that stopped oil loadings yesterday. Then it started them again. Now it's stopped them again because of another drone issue or attack. There was also reports that production at the Shah gas field, which is again in the UAE, that has been cut as a result of an Iranian drone attack. I think that's actually quite an important one. Yeah. Because thus far we've seen these drone attacks targeting things like refineries and export terminals and ships. We haven't actually seen them targeting the gas and oil fields themselves. So it's worth bearing in mind, is that the potential for escalation? Were you going to say something then, Ryan?
No. I just agree with you.
So that's, of course, worth paying very, very close attention to. As I said, Trump again saying yesterday that the war will be over soon, but not this week. He was also talking about how Iran wants to make a deal, and that they are talking with our people being the US people, of course. There were also some sources reports yesterday that the Iranian foreign minister, who's got an unpronounceable name, has been talking over text messages with US envoy and Trump's best mate, Steve Witkoff. That was actually denied by the Iranian side very shortly after. But I think the sort of nub of all of that is there hasn't really been anything fresh from a fundamental perspective over the last day or so. We're still dealing with a situation where energy infrastructure is being attacked. We're still dealing with a situation where, for all intents and purposes, the Strait of Hormuz is impassable. I mean, yes, there have been a handful of tankers getting through. 2 Indian-flagged gas tankers made their way through yesterday, but transits are still obviously way, way down compared to where they were, before all of this kicked off 3 weeks ago. And of course, we are still dealing with a commodity market where supply is getting tighter and tighter and tighter, despite the move lower that we saw in the front crude benchmarks yesterday.
Yeah, no, exactly that. And I think one thing to flag and one thing to note is, like I said, markets are acting calmer than we've seen recently. There was big news yesterday morning that the gap was only 3%. To give you a guide of how.
Yes, it wasn't 30%.
Yeah, no, quite exactly. And there's you can argue there's a few reasons for this, right? That we know headline fatigue is a genuine issue with markets. If you keep having the same headline all the time, it's going to have smaller reactions in markets over time. But also, we are getting a lot of mixed signals right now. So it almost feels like this is, it's not really a question of whether the headlines have slowed, because they haven't. It's whether the markets have simply priced in more of a prolonged conflict and now treating daily updates as more noise than signal. Because obviously when everything's new and everything's kicking off and, there's a bomb here, there's a bomb there, missiles here, this has exploded. Like you said, a lot of kinetic energy, a lot of kinetic warfare, which leads to a lot of kinetic headlines, right?
Yeah, and I think, it's understandable that markets would become desensitized to that as time goes on. And this is where, markets can appear somewhat heartless at the end of the day, because obviously, we can't forget the human impact that all of this is having, all the missile attacks and all the drones and all the rest of it. However, as you rightly say, Ryan, and I think markets have probably got to this point now where we've just kind of priced in the fact that we are going to have seemingly endless, at this point, obviously we hope things come to an end soon, but seemingly endless news around a missile's been launched from here, a drone has hit this, etc., etc. And unless those headlines represent a material escalation, either in terms of what's being targeted or who's being targeted or the damage that's been done, then markets are, kind of logically going to be a little bit unreactive to that.
Yeah.
And I think the other part of the story that, again, people have almost forgotten about because the geopolitical situation is taking up so much bandwidth at this point is that there's actually a hell of a lot else going on this week. You think we've got a Fed meeting tomorrow, we've got a BOJ meeting in the early hours of Thursday, we've got the BOE and the ECB Thursday lunchtime. And we're not expecting any policy action from these central banks, but it is going to be the first time we've actually heard from them in terms of how they're viewing the situation and what their reaction function looks like in terms of this situation. So in a market that's already dealing with quite a lot of uncertainty and now has this scheduled event risk on the horizon too, I think it's unsurprising that that's going to, further dent anyone's conviction behind doing too much until we've heard from Powell and Lagarde and Ueda and the rest of them.
Absolutely. And before we go on to, obviously, because the FOMC meeting does technically start today, and we have got Reeves later on. So before we just chat about that, what you said there leads me perfectly, and this is obviously never planned, as regulators know, into one risk that I was going to flag. And there is a risk when markets do start pricing in or pricing out noise and just start being a bit kind of, the fatigue sets in, headline fatigue and whatnot. The risk is that fatigue-driven calm, it can shatter very, very quickly. Well, it can shatter instantly if something actually changes fundamentally on the ground or something else happens elsewhere in the world. Now, the market isn't saying this is fine. It's saying we've adjusted our baseline to what's going on here. So if something comes in that's genuinely is, serious ramifications, sometimes people can be caught a little bit off guard on this because they have kind of desensitized, even subconsciously, they're just like, oh, it's another headline. Now, some of the best headline traders that I know, fortunate enough over the years to know quite a few guys that they've been headline trading for like over a decade, right? They were the first people to start really doing it professionally. Like I've been on one team of traders that I've mentioned on the show a couple of times without naming who they are, and I won't do that because it's not fair to them. But where they excel is they would have switched off from the noise headlines, bomb here, missile here. They would have done that last week because there's just no upside for them. But they will still be watching every headline that comes down the pipe on the Bloomberg terminal, on the Reuters terminal. And they will now be waiting for the next big headline that for most people that are trying to trade headlines will probably pass them by because they've seen something similar too many times. So the real risk here is something big does happen, maybe not even in the Middle East. Maybe it's a policy announcement, or maybe it's something else that Trump says or someone else says in the world, or maybe it's a yen rate check or something like this. All these things are still going on in the world. It's very easy to forget that life outside the Middle East is still going on. So again, this is when you've got to be really careful as a trader. It's very easy to get sucked back into putting on bigger size because the markets are moving, not as much as they were 2 weeks ago. But the markets are still in a very, very precarious state. So if it's me giving any trader advice right now, it'd be to still treat the markets that they could go. Say for an oil market, for instance, treat it as if it could still go 30% of the day. Because right now we don't know that it couldn't.
No, we certainly don't. And actually, if you look at things like implied vol, they are still at very, very elevated levels, which, extrapolate from that. Yes, it very much could. And, options are pricing that possibility with a relatively high degree of plausibility and of certainty. So, although things do seem to be a little bit more becalmed than they were earlier in the week, and certainly last week and the week before, we're not out of the woods, I think is the overall message. But speaking of other people who aren't out in the woods, we hear from Rachel Reeves today. Yay! So Rachel Reeves is going to be, we'll do the rest of the day ahead in a second, but Rachel Reeves is going to be giving something called the Maze Lecture at 1:30 this afternoon. This is essentially just an economic keynote speech that she'll be making at the Bayes Business School, which is actually just around the corner from where I'm sat at the moment. According to Politico, Rachel Reeves is going to, and I'm quoting here, make the case that Britain will be an active and strategic state where the markets won't get to determine on their own where economic growth is. That seems like probably the most ridiculous thing it's possible to say. We've also got some lines from Rachel Reeves, who says that in this speech she will make 3 big choices on the greatest growth opportunities for Britain in the decade to come, including growth in every part of the country, AI and innovation, and a deeper relationship with the EU. Now, first things first, I think growth growth in every part of the UK is an admirable aim, but there are various structural challenges to that. And unless it's accompanied with policies, it's just complete meaningless twaddle. AI and innovation, yeah, great, very noble aim. But have you seen where energy prices are, love? Because no one's going to want to build data centers or computing gear here, particularly when we've got an energy price shock on our hands. And a deeper relationship with the EU is basically just what Labour Party politicians reach for when they're out of any and all other possible ideas. So it's one to keep an eye on. I don't think it's going to be a massive market mover in terms of gilts. I think it's also important to view this through the lens of actually, even if they are realistic policies that could well be delivered at some point, is Rachel Reeves going to be around to deliver them? Because again, I was asked this by a journalist yesterday. We've kind of forgotten the fact that Keir Starmer's leadership is still teetering on the brink. We're kind of, 6 weeks now away from local elections here in the UK that seem to be getting no coverage at all because of what's going on in the Middle East. But again, this is one of those narratives that is still there. Those Labour MPs who are plotting to overthrow the Prime Minister, they're still going to be plotting away. So, yeah, Rachel Reeves is going to be speaking. She's going to be giving a bit of a sort of party political propaganda blast. But is she going to be around to actually enact anything of what she says? I would highly doubt it, to be honest.
No, absolutely that. No, sorry, I was just sitting there thinking what a sham that she is. But yeah, then you caught me off guard.
Yeah, there's nothing new there. The other thing that, of course, is worth bearing in mind while we're speaking of the UK is the moves that we've seen in gilts since all of this began in the Middle East. Because, of course, the 10-year gilt this morning is trading at 4.75% effectively, as near as makes no difference. That's it's about 50 basis points higher than we were the day that this all started. But more importantly than that, it's about 30 basis points higher than where we were when the OBR captured their assumptions for the spring statement forecasts.
Yeah.
And in that document, it says something along the lines of a 1 percentage point rise in yields across the curve wipes out approximately 15 billion pounds worth of headroom. Well, we've seen a third of that already. So that's 5 billion quid gone before she's even started.
No, I mean, yeah, let's be honest, it's all in a really terrible shape. And one thing to note is that just because we're talking about UK politicians and how fucking useless they are, Ed Miliband.
All day.
Ed Miliband, obviously the UK's energy secretary that fucking doesn't really understand how energy markets work. One thing that I noticed yesterday was basically I think it was the chairman of Renewable UK, one of like the biggest renewable kind of industry groups in the UK, obviously, has basically turned around yesterday and called on Ed Miliband to open up licensing and stuff to the North Sea. And even this is the guy that's basically leading the UK's renewable companies has turned around as the energy minister and said it's actually a good idea to tap into fossil fuels in the North Sea. Now, is he doing that because he realizes that at this moment Ed Miliband is actually possibly the worst poster child for renewables, and it's actually poisoning renewables full stop. So
yeah, I mean, Ed Miliband's just out of his depth.
But you see my logic. Like, if you've got someone like, again, I'm going to take this far too far, and I apologise profusely. But imagine Hitler was a vegetarian. Now he didn't do vegetarianism any good PR. So the Vegetarian Society would probably like the fact that we didn't talk about that. Whereas, and I'm not saying Ed Miliband is Hitler, but he might be an equivalent to an energy Hitler, renewable Hitler. But there you go. I hope the AI summarizer picks this up.
I really hope it doesn't.
But do you see my point?
Yes, I do see your point. Worryingly, I don't quite understand how I see your point after that analogy. But yes, I do get where you're going from. I also think it's just utterly mental, to be honest, that the UK is sat next to the North Sea, which is full of oil and full of gas. Yes, those reserves are lower than they were a number of decades ago, but they are still there, and countries like Norway are still tapping into them on a daily basis.
And we're still buying from Norway that are tapping into
exactly
this for the right of our ones.
It's purely down to basically politicians being obstinate and so ideological that they don't want to actually drill for energy in the North Sea. And all of this nonsense around, it doesn't matter where it comes from, or we could drill but sell it internationally. Well, yeah, what's wrong with that? That's kind of how the market works, guys.
Well, yeah, so you're
We
referring
have a
to,
commodity, we sell it, we get revenue from it. What's not to like?
yeah, you're referring to a Labour MP at work, a Labour policymaker or whoever, basically tweeted the other day, oh, we know even if we did drill the North Sea, there's no guarantee that those barrels or that gas would come into our forecourts, etc. Like, so this is someone that clearly has no understanding how energy markets and how, how the energy system works. Not only will we be getting tax revenue, not only will jobs be created, not only is it more oil and gas into the system, but more importantly, just the makeup of how the oil in the North Sea is shipped ashore and whatnot, it does directly come to the UK. And it's far easier
Yeah.
for us to sell stuff that comes in that way than, new stuff that goes in that way than import it. It's just it's giving me a headache, and I've already got a headache.
No, it is ridiculous, and it's going to give me a headache as well. So we will move on to the rest of the day ahead. I will caveat this, of course, by saying that economic data still doesn't really matter too much to markets at this moment in time. However, actually overnight, we had a policy decision from the Reserve Bank of Australia. They did indeed hike rates, as expected, by 25 basis points to 4.1%. It was a narrower vote than expected, though, voting 5-4 in favour of that rate hike. Although, according to Governor Bullock, the four who preferred to hold rates steady this time around, it was more an issue of timing. They would just prefer to wait until the next meeting for a rate hike as opposed to not wanting to hike at all. So the Aussie dollar pretty much unmoved, bang in line with expectations there. As for the rest of the day at 10 o'clock this morning, we get the latest ZEW sentiment surveys out of Germany. The expectations metric, that's seen falling to 39.2, down from a prior 58.3. This is March data, so of course it's going to be impacted by what's going on in the Middle East and the energy price shock. The current situation metric, that's also expected to decline, down to minus 68 from a prior minus 65.9. And then across the pond at 2 o'clock this afternoon, we get the latest pending home sales stats from the US. And then at 5 o'clock this evening, London time, we have a 20-year bond auction. Again, of course, the 20-year is very much the unloved segment of the Treasury curve. So there is unlikely to be much by way of signal that we can extract from those auction results. Other things to bear in mind, of course, another torrent or deluge of geopolitical headlines as we move through the day today, although, as we said, markets are becoming somewhat desensitized to those developments. And of course, as Ryan mentioned a short while ago, we do have the start of the FOMC's two-day policy meeting today. They will obviously announce policy tomorrow evening here in London, tomorrow afternoon in the States. We do get a dot plot. We get the latest summary of economic projections as well. And of course, we get Jay Powell's press conference. We will cover that in much more detail tomorrow. But again, as we already discussed, do bear in mind that anticipation in the run-up to that FOMC may cap conviction to a little bit of a degree.
Exactly. I mean, if there was a week not to have on much risk at all, or any risk, it would be this week, really, because not only have we got the Middle East, not only have we got the quad triple witch in whichever markets you're trading, not only have we got central bank decisions, there's a lot going on, let's be honest.
There is a hell of a lot going on. It is, it's one of those where it almost feels like, and I'm going to zoom out massively here, but it almost feels like, participants have taken down risk levels over the last couple of weeks. We are effectively into week 3 of what's going on in the Middle East now. If you ask yourself, you're running a book, is this week the week to add risk? Absolutely not, because geopolitics is still very uncertain and you've got all of these central bank decisions in the mix as well.
Yeah.
Next week the week to add risk? Well, I know it's a bit of a cliche, but next week is month end. It is also quarter end. So do you want to get in the mix with all of those flows? Probably not. The week after that is Easter. Do you really want to add risk into a 4-day weekend in the majority of the Western world? Probably not. Are we looking at the week beginning the 6th of April for when participants come back and maybe look at things with calmer heads, maybe look to take up risk levels? I don't know. Of course, the geopolitical situation could be and almost certainly will be very, very different at that stage. But it does have the feeling of one of those periods of time where if you don't have to trade, you probably don't want to.
Yeah, and when we say this, what we're kind of specifically saying, like real money funds and whatnot, where that are looking to deploy serious cash. We're not talking about day traders or anything like that, because obviously because you lot are degenerates, we can't stop you trading. But
if you want to try and nick 5 pips out of cable 10 times a day, then you're going to be able to do that no matter what. But
if you've got
the serious players,
no, exactly that. Well, that's the end of the show, Michael. Thank you so much as always, my dear friend. Listeners, thank you so much. Hopefully I'll be back to far more fighting form tomorrow. I'm certainly feeling better than I did yesterday, which is a good sign. And yeah, whatever you're doing today, keep it tight.